Good morning to all. I'm Suresh Iyengar. I'm a business advisor at the North Central Texas Small Business Development Center. Today is National Pancake Day. Be sure to celebrate by adding favorite syrups and toppings. SBDC is a leading provider of assistance for small businesses. We are grant funded, which allows us to offer services at no cost to you, the business owner or entrepreneur. Quick reminder for today's session, we will be recording this webinar and then adding it to our YouTube channel. Today's webinar will be interactive, so please feel free to raise your hand, which is the small button at the bottom, if you have a question or comment. Our presenter today is Bryce Forney. Bryce is a Bay Area sole proprietor, CPA, preparing tax returns mostly for business owners who use CloudBooks for their business. He is an understandable, likable, mobile accountant working in hotel lobbies, libraries, and liquid spaces. Welcome, Bryce.
Thank you.
Over to you for your presentation.
Super. I just need to find my screen here. Apologies for that. So today's topic is really near and dear to my business heart. We're going to be talking about reducing income tax while simultaneously saving for your retirement. Few options within the tax world are quite as compelling as saving for your retirement. And so I hope to make that case today to make it as clear and as obvious as possible about what a great opportunity this is to put away money so that you can enjoy it's been called many things, whether it's the 7 Sundays or the intentional unemployment, whatever you want to call it. We need to save up for that. And so that's what today is about. Of course, it's important to use your resources as a business owner, and the SBDC, and specifically the North Central Texas SBDC, are great resources for your business available to you to make sure that you succeed. It's a great aspect that we have here in the country. So my background, I am a CPA. I prepare tax returns for a living. I'm also very involved in QuickBooks, in clients' QuickBooks Online. I also support other cloud books, but not many people use other options other than QuickBooks Online. But I do support clients who use Xero, that's Xero. That's kind of the closest competitor to QuickBooks Online in the cloud accounting world. Sage has an option, and there's another one called Accounting Suite. They're great products. They're just not as well adopted in the United States as QuickBooks Online. So that's my background. And we're going to start right in on defining what deferred compensation is, or what tax advantage retirement, what that means. So as a self-employed individual, you have a special opportunity to be able to save for your retirement. And I say special because the amount that you are able to set aside for retirement and simultaneously get a reduction in your taxable income, the amount is larger than it would be for many employees. So as a self-employed, you can contribute to the primary ones that self-employed individuals use are a SEP IRA. I used to know this as a self-employed person. I thought that was the SEP. It's actually simplified employee pension, but either way, it means really for one solopreneur, you can use it if you have employees, But the thing about a SEP IRA is that you need to contribute the same amount as a percentage of income for every team member. So businesses that have 2 and 3 employees typically shy away from this because if they want to give a 20% contribution to themselves, then they're also contributing 20% of an employee's pay to that employee's retirement account, and the funds need to be sent straight away. So there's no vesting period. It's all 100% vested. So the SEP IRA is designed. My point behind that is, and do I have one, is that this is designed primarily for a solo professional. And then there is also a 401k plan that a self-employed individual can open. And the 401k for a solopreneur is known colloquially as a solo 401k or a solo K. So if I'm using, I'll probably use the term solo K. That's what I'm most familiar with. And the 401k, the solo K, is very similar to the SEP IRA. It allows the same contribution rate as the SEP IRA, a high dollar volume in relation to your income. And in addition to the percentage of income contribution, it allows you to contribute another $22,500 if you are age 49 or younger, or up to $30,000 in addition to the percentage of income amount. So these contributions are really large, very liberal for you to be able to contribute to your retirement and get a tax deduction. So when we're talking about deferred compensation, what we're talking about is contributing to your retirement account, and for every dollar you contribute, you are reducing your income subject to income tax. It's that simple. You contribute, if you have $100,000 net income on your, if you're a Schedule C, which most small businesses are, reporting on Schedule C, your line 32 is $100,000. You're going to be able to contribute, if you contributed $5,000, then that's going to reduce your taxable income to $95,000. Now the numbers are a little bit different because there's this there's a tax called self-employment tax that covers Social Security and Medicare for self-employed people. So the calculation is a little more complex than that, but we're going to simplify just so you understand the concept. So you contribute $5,000, you reduce your taxable income by $5,000. It's that simple. And what the strings attached to deferred compensation are that when you contribute those dollars, you are saying, I'm not going to pull out that money until I'm age 59 and a half. I do not know how they come up with the half year, why it can't just be 59 or why it can't just be 60, whatever the case. So when you are 59 and a half, you are able to withdraw as much as you want without a penalty. So that when you withdraw, that becomes taxable at that point. So only if and only for how much you withdraw, that becomes taxable income later in retirement. So you're getting a tax deduction now, and it's going to be taxable later, but you could have 25 or 30 years between those points. So the big benefit is to invest now and get the tax savings, grow that money as investments grow, so that when you take it out, it is a much larger number. And we're going to give examples later so that you can see in real terms what that can become. I just finished the book, The Algebra of Wealth by Scott Galloway. It was outstanding, and he goes into quite a bit of time value of money, essentially, and the value of investing early and investing quite a bit. By the way, some presenters like to begin by saying, this should not be construed as tax advice, I'm just giving information, I am giving you tax advice. You can take this to the bank, what we're talking about today, because this is really valuable for any small business owner. So now that you understand the concept of putting the money aside in your account for your savings, and the IRS, and if you have a state tax agency, giving you a reduced taxable income in exchange for saving for your own retirement. If it sounds too good to be true, it does sound too good to be true, but it is absolutely true that the tax agencies are heavily incentivizing small business owners to save for their own retirement. I don't think there's a bigger giveaway in the tax world than the deferred compensation. And I should also mention, before we go into this example, there are other plans for self-employed individuals. So we're talking about the SEP IRA and the Solo K today, but there are other options. There's a thing known as SIMPLE. That's an acronym, SIMPLE. And that is sort of like both a 401k and a SEP IRA. You get a little bit larger contribution for the owner in exchange for making a specified amount of contribution for employees or based on their participation. So, I'm trying to think of another option for retirement. There's one other that I just can't think of, but I'm just focusing on the SEP IRA and the Solo K today for simplicity, so that you get the idea, you can get some examples. And for self-employed individuals who are solopreneurs, this is the big opportunity. So with the contributions, you get to decide how much you contribute. And what I want to do here is clarify the maximum amounts that you can contribute, and so that you get a sense for how dramatic these contribution levels can be. So as I said in the last slide, the contribution is a bit convoluted because of self-employment tax. I mean, if you really want to know, self-employment tax is 15.3% up to something like 160,000 today. And then the FICA, the Social Security part goes away, and the Medicare continues at 2.9%, no matter how much you make. That self-employment tax, half of it gets deducted for purposes of determining what your net I don't know why I'm putting it in quotes. It's an actual thing, net self-employment income. And that's actually the basis for the percentage calculation. For simplicity, we're going to say it's about 20% of your net income. Schedule C, line 32, it's going to be about 20% of that number. That's the SEP IRA opportunity. That's a lot. One out of every $5 that you earn, you're going to be able to put away in your own retirement. You're putting it away, you're saving for your retirement, which is great, and you're getting a tax deduction for doing it. There are not that many opportunities in the tax world where you can actually pay something out where you actually get to keep it's having your cake and eating it too, literally, because, well, not literally in the sense of cake, but you're saving this money for yourself, and you are getting a tax deduction for doing it. That, I think, is extraordinary. So it's about 20% in the SEP IRA world. And in the Solo K world, you're getting that same 20% of net income, but you're also being able to put away, as I mentioned before, another $22,500 a year or $30,000 a year if you're age 50 or older. And this 20% figure does technically have a cap. So you can, for a SEP IRA contribution, you can contribute 20% of your net income up to a total of $66,000. You're not able to contribute more than 66,000. I don't actually know why this rule is in effect, but if you're making more than, I can't do the math in my head, it's somewhere around 300 and $350,000 a year. Somebody's going to be able to correct me on that. But so anyway, so I guess the idea is if you're making $1 million a year, they don't want that individual to be able to put away, you know, the $200,000 about. So there is a cap. All of these retirement plans are designed for a small business owner, not for a wealthy industrialist. So the SEP IRA, very easy calculation as a percentage of income, and you can contribute about 20%. The solo K, you get an additional what's known as the employee deferral, even though a sole worker is not an employee, it is the extra deferral that they get. The solo K, by the way, there's some paperwork involved where you need to establish the 401k plan before the end of the year that you're going to make contributions for. So you have to have the plan in place. You don't need to make contributions by the end of the year, but you need to have the plan established. Whereas with the SEP IRA, you could technically decide in the first week of April of the year after the tax year that you want to start a SEP IRA. You could open the account at the brokerage in the subsequent to the tax year and make contributions. As long as you make the contributions by the due date for the tax return, typically April 15, or the extended due date if you're on extension. So very liberal in terms of time as well for making the contribution. And you do have the same time limits on the solo K to make the contributions, but you have to have the plan established by year end. So if we use an example of a sole proprietor who is 50 years old or older, and that sole proprietor makes $100,000 as their net income, or really as their net self-employment income. No, it's actually, I've calculated it based on $100,000 as net Schedule C, like line 32 of Schedule C. If that amount is $100,000, then the maximum that taxpayer can contribute to a SEP IRA would be $18,587. So see, it's not quite 20%, but it's pretty darn close. So you can figure it's basically 20%. The maximum that taxpayer can contribute to a solo 401k is that same $18,587 plus another $30,000 because this is a 50 plus taxpayer. So in total with the solo 401k, a taxpayer making $100,000 can contribute almost half of it. And as I mentioned so many times, I feel this is so critical to communicate. If the taxpayer did not make the retirement contribution, they would pay income tax on $100,000. By making the contribution, the solo K, at maximum, they would literally cut their income tax in half. So they would only be subject to tax on $51,413, $513, something very close to that. So there's a dramatic reduction in income tax. And keep in mind, the taxpayer still owns that account. That money did not leave. It left their checking account, went into a brokerage account, but it's still theirs. And as long as they don't take it out before they're 59 and a half, there's no penalties. If someone does take it out before the age 59 and a half, then they are subjected to penalties. I live in California. California has its own penalty, and the IRS takes, I think 10% is the penalty federal. And in California, there's I think it's 3% comes off. So if someone is to use these retirement funds, prior to retirement, the tax hit is heavy. I've seen cases where people get in an emergency situation, they tap into their deferred dollars, and they can end up with 40 cents on the dollar because that money is subject to income tax, as it always would be at distribution. And then in addition, for California taxpayers, they're paying about 15% in penalties. So you can very easily get to over 50% in terms of the tax and penalty hit. So I want to also communicate the actual tax savings in an example. So we're going to use the same taxpayer let's say the taxpayer just had their 50th birthday. They're a 50-year-old sole proprietor. They've got $100,000 of net income on their Schedule C. They live here in California. Excuse me. So they have state tax in addition to federal tax. And that means that their income tax at the margin, just meaning for dollars they're earning right now, they are subject to a 30% total income tax rate, which is not uncommon. That's relatively conservative because federal tax rates can easily get between 20 and 30% themselves. And our state income tax rate in California, unlike the federal rates, the state rate goes from 0 to 10% at a much faster clip. So 30% is a reasonable figure. This is not some zero money down scheme, and I'm making up numbers to make the impact really significant. This is a common example, if not conservative example, of the tax savings. So for that taxpayer who contributes the $18,587, they are going to reduce their income tax by nearly $5,600. That's the actual tax that is going to be saved. And for a solo K contributor who's contributing at maximum, for their almost $50,000 contribution, they're going to save just under $15,000 in actual tax. And I want to emphasize that the choice here is either you're paying tax or you're paying yourself to your retirement account. It's literally that simple. So I can now I still have to contribute a lot of money, but I can contribute the 18,000 and end up with 18,500 in my brokerage account, in my retirement account, or I'm going to pay that $5,600 in tax, and I'm going to end up with 12,000, and it's not going to be in a retirement account. It's just going to be, say, in my checking account. So if you make the contribution, you're getting an enormous tax impact. If you don't make the contribution, you're going to pay that tax to the IRS, and in my case, the California Franchise Tax Board. So I want to give some more context around what's going on with the dollars, because I feel like the biggest impediment to people participating in retirement is a lack of understanding of the mechanics of how the retirement contributions work. So that's why I keep going over you can save it or you're going to have to pay more tax, because that, I think, couches it in the right terms, where you're actually going to lose out on, in the example, about 30% of the dollar amount that you're going to contribute. So if we've got the same example here on the left, I've just shown it. I just want it to be there for you so that you don't lose any of the elements of that example. So the contributions that you make are adding to your savings. They're adding to your net worth. And the IRS and California Franchise Tax Board, for Californians, are helping you pay, in the example we've given, about a third of what you're contributing. So another way to say that is that if I put away the maximum in a SEP IRA of 18,587, I contributed all of those dollars. That's true. But if I had not contributed it, I would have had to pay $5,600 in tax. So in that way, net net, you're contributing about 2/3, and the tax agencies are contributing another third, a little less than a third in this example. So because otherwise you would have had to pay that third out as income tax. So it's either pay yourself and get the tax agencies to kick in quite a bit, or if you do not contribute to retirement, that of course is a decision each taxpayer has to make, then you're going to pay a dramatic amount more in income tax. In these examples, $5,600 or almost $15,000. So another way to look at that initial contribution, since you would have had to pay it out, a third of it, in income tax anyway, it's the same as saying I contributed about $12,000 and the IRS kicked in about $6,000. So I got an immediate 30% return on investment. Even if I just put that money in cash, you can invest in basically cash, bonds, or stocks. And if you are wary of investing in stocks, even if you put that in cash, where you're getting essentially a very flat rate of return, very nominal rate of return, you're still ahead because you got the tax savings for making the contribution. That money would have left your account if you had not made the contribution. So if we figure that we've made the SEP IRA contribution of the at maximum at 18,587, and we did that for 22 years, and we figure 7.5% growth on that investment. So that's still conservative for a stock investment. I'm a big believer in the American stock market. So my dollars are in the S&P, and I'm an index fund investor. I'm very cheap in terms of brokerage. But I believe that over time, that's where the growth is going to be, and I can tolerate the volatility. It is, and I eat my own dog food. I did lose about half of total dollars invested when we went through the 2008 situation, but that came right back. So as long as you're fine with volatility, the stock market has returned over 8% for a long time, over the long term. So if we figure that we're contributing the maximum over 22 years, we've got 7.5% growth, the taxpayer will have put in a total of $286,000. The tax agencies will have effectively put in $123,000 to make the total contribution amount just over $400,000. That would come to over $1 million, meaning the growth itself over that 22-year period would be much more than the contribution itself. So the growth would be nearly $600,000 to get to that $1 million balance 22 years later. So why, if this is such a screaming good deal, and of course, any taxpayer, it seems, would want to make this retirement decision, why on earth would a taxpayer decide, no, I don't want to make that retirement contribution. I don't want to save income tax in exchange for saving for myself? And the reason is that we could end up with that $1 million balance by making the maximum SEP IRA contribution. If we've got $100,000 income over a 22-year period, we can end up with $1 million. So why on earth would somebody not do that? And the reason is it does require cash management. So for the same reason that taxpayers struggle to be able to make the quarterly estimated payment amounts, and for the same reason that taxpayers struggle to come up with the tax due when the tax return is filed, especially if their business is growing, and the same reason that people struggle to save for property tax that occurs, at least in California, it occurs in April and November, saving for vacation, making car purchases, all of those decisions where we have a big cash outlay, even in the light of having a great tax savings, taxpayers many of them will seemingly be unable to manage their cash to be able to make the contribution. So it's really important to, if you want to take advantage of this amazing retirement opportunity and tax savings, you have to keep in mind that this is going to be at maximum about 20% of your net income, meaning that for every dollar that you take in net after all of your expenses, you're going to need to set aside 20%. So if you have a system already for, maybe it's for coming up with your estimated tax amounts, then this would be an addition to that. I don't think it's that difficult to say, okay, if I made $1,000 in a given week, I need to put $200 aside for my retirement contribution. I may need to put another $200 or $300 aside for income tax. And I may have some more things that I need to set aside so that I know for the $1,000 that I made in that week, the amount I have available to spend on going out to dinner and living life is going to be a lower number. I think that's where people get sideways on cash management. So let's go into an example. If a taxpayer wants to maximize the SEP IRA contribution, this is giving the cash management picture, which is really, I think, the most important part of making retirement contributions. I think that's where people typically fall down on not being able to make the contribution. So because I want you to be able to succeed in making the contribution and saving the income tax, and being able to find that 7 Sundays once you decide to voluntarily retire, I'm going to go through an example. We're going to use the same taxpayer, $100,000 net income. That means that sole proprietor has $100,000 to start with. If we set aside 30% for income tax, that would be $24,000, including, no, that's not including self-employment tax. So we got $24,000 just in income tax. And the reason it's $24,000 and not $30,000 is because we got the deduction for the SEP IRA. Pretty clever, huh? So we've got $100,000 income, 30% rate of tax. Why would the amount that we set aside be lower than $30,000? And the reason is we made that $18,000 contribution. So we saved $5,600 in tax. So we're rounding. We only have to pay $24,000 in income tax. That's a benefit, but it's still a big number. So we're going to set aside the $24,000. We've got another $15,000 to set aside for self-employment tax. And we need to save the about $19,000 that we're going to put into the retirement account itself. So just based on that, we start at $100,000, we take away $39,000, That's for the income tax and self-employment tax. And we take away the $19,000. That's our retirement contribution that we're going to make. We end up with $42,000 for living expenses. And that means most important, I think, in that is to know that of the $100,000 net income that we brought in, we really have just over 40% to be able to spend on living expenses. And I think that's where people get, as I alluded to earlier, I think that's where people get most often mixed up because they think I've got $100,000. I can really spend on this, and whether it's a new car or some other lavish, maybe a vacation, they might be thinking, well, it's a percentage of 100,000. But really, if we're going to make this large retirement contribution, we're going to get the benefit of the tax savings, but we still need to keep in mind that our base number as far as what's available to spend is 42,000, not 100,000. So this taxpayer needs to set aside about $4,800 a month from the $8,350 a month that they're bringing in. This is assuming, even income throughout the year, which is not the case for me. I make over 80% of my revenue before April 15th, or as of April 16th anyway. So that 40% figure really becomes what that taxpayer has available to spend. And that's where many taxpayers have a difficult time just assimilating that information, that of every dollar that I've really made after all of my expenses, I have less than half of it to spend on my own. But if you want to prioritize retirement and you want to end up with a really large number at the end of the stream of earnings, this is the way to do it. I'm a poster child for contributing to deferred accounts over time. I started my IRA when I was 18 years old. Yeah, some of us really know we're going to be accountants from a very early age. And while there have been periods in college, particularly where I didn't work and didn't contribute, every year that I've worked, I've contributed. And this, referencing that the Algebra of Wealth book by Scott Galloway, he speaks about how early contributions grow so dramatically if you just have time. And I can absolutely tell you that's true. The snowball is phenomenal. So that's my incentive point for really managing your cash well to be able to make these contributions. So now let's switch gears and say that we want to make the maximum solo K contribution with the same example of the $100,000 earner. If this super saver wants to set aside the nearly half of net proceeds in the business into retirement, then they need to put away $15,000 for income tax. If you're thinking, wow, that's a really low number, especially compared to the $24,000 we had when we maximized the SEP IRA, you're right. And the reason is we're contributing almost half of our income to retirement. Therefore, the income tax goes way down. We're getting a nearly $15,000 tax savings in exchange for contributing to retirement at this level. We've still got self-employment tax. That self-employment tax is on the $100,000 figure. We don't get a deduction for self-employment tax for retirement contributions. So our retirement contribution is going to take another almost $50,000. So if we do the same countdown from our 100,000 starting point, we take 30,000 out for our income tax and self-employment tax. We take 49,000 out for our retirement contribution. That leaves us with just $21,000 for the year to be able to live on. So this taxpayer needs to set aside about all but $1,750 a month from net business proceeds. So of the total that the taxpayer's bringing in, $1,750, especially here in the San Francisco Bay Area, really wouldn't get you very far in terms of living expenses. So what I want to point out, it's great if you can do it. There are individuals who are really regimented and militant about minimizing expenses. It's certainly in the possible range. Most Americans don't want to commit to that type of living. But this retirement prioritizer really, in all likelihood, needs to have some other source of savings or some other source of income, like a spouse's income, to be able to make this plan work. So where I've seen it in the wild working is with taxpayers who are really at or near retirement anyway. So because they have the resources, their expenses are minimized by that point. So those are the taxpayers who can do this. The irony is that for a 20-something or 30-something taxpayer who could commit to this plan even for 5 years, that contribution, if they just did 5 years from age 30 to 35 and then left it alone for another 20 years, that would still grow dramatically. So it's not very common, and I want to point out that it's not very common. I don't want to make this sound like, oh, it's really easy to open a solo K and contribute the maximum. So, but it is absolutely an option that's out there. And the most important thing I feel about any taxpayer's ability to contribute to retirement is their ability to manage their cash. And so if you're regimented about, for each dollar that I net after all of my business expenses, I'm going to set it aside, whether it's, in envelopes or some form of that you allocated on a spreadsheet, and you don't overspend, then you're going to be in great shape to be able to make your tax payments and to be able to make your retirement contribution payments. So I thought here at the tail end, just for grins, that we would consider how much would, if we contributed the maximum, in this example, $100,000 taxpayer who's older than 50, living in California with our same tax rate at 30%, if we contributed that nearly $50,000 for 20 years, we were using more years in the other examples, for 20 years, same growth rate as 7.5%, where we're contributing 50,000 over 20 years. So already that we should have $1 million, pretty close to it, because we're doing 50,000 for 20 years. But how much would that investment grow when we're making that contribution each year over 20 years? And the answer is over $2.1 million is what that balance can grow to over 20 years. So this is a really dramatic example, but it also shows the time value of money and what that money can do if it's invested, and particularly over time. This balance doesn't really start to snowball until you're about halfway through the plan. So it's sort of like I read somewhere that most of Warren Buffett's wealth was really, he was always a relatively wealthy individual, but in terms of the extraordinary wealth, that didn't start to happen until he was about age 50. And I think the reason is that's when the snowball effect starts to happen, where the money is growing at a faster rate than he can, well, he alone can probably keep up with that, but most individuals have some sort of set cap to what they can earn based on how much time they have and how much the market is willing to yield. So in this case, the taxpayer is contributing about just under $1 million. Tax agency subsidy there is nearly $300,000, and the growth total is $1.2 million. So with that, another call out to, of course, the importance of using your resources with SBDC. So, I mean, there's just nothing more important than using resources that are available to you as a small business owner, and the SBDC is a great place to go. So with that, I'll take any questions, or we can wrap up. What comes to mind?
Bryce, I do have one question, if I may.
Of course.
We talk about that retirement age being there, and you just made a great reference to Warren Buffett. But can you still continue this type of investing well beyond or into your retirement years? So here you are at 59 and a half, but you plan on owning this business for a longer period of time. Can you just keep doing it into your early 70s or whatever?
Yes, absolutely. And I'm glad this came up because I failed to call that out. So the ability to contribute to the retirement plan is available to anyone with self-employment earnings. So there is no age limit on when you can make contributions. So you could be 78 years old, and if for some reason that consultant is able to earn, those self-employment earnings can be contributed to a retirement plan. And so you could even have the situation, I mentioned that age because you could have the situation where a taxpayer is contributing to retirement, and also because they're more than age 70 and a half, be required to take distributions from retirement, the required minimum distribution. So yeah, and I've seen situations with taxpayers who are taking out of their retirement and also putting in, so they end up with kind of a net zero on taxable income. But yes, in short, the answer is yes. As if you have self-employment, self-employment income, you can contribute to a retirement plan.
Yeah, great. We have a lot of business owners that come in or want to be business owners that are ending their careers, right? And now wanting to start to do some consulting or in the industry they spent so many years in and doing that. So
the second act,
great way to, continue to do that.
Yes. Yeah, that's a good point. Somebody who's doing second act might be uniquely qualified to contribute to a retirement plan. Just to minimize their income tax, even if they've already saved enough through their employer plan.
Any other questions? If you don't have any questions, I'm going to share my screen here. Thank you all for joining us. We will be sending out a survey to get your feedback on this webinar. We have some upcoming webinars, October 1st, Generations in the Workplace. Then Bryce is coming back again to do another webinar, choosing the most tax efficient entity for your business. We have QBO, Generations in the Workplace, and a few other webinars in October.
There's a duplicate there.
Yes, looks like it. I didn't want to read it again. Yeah. So we do have the website at sbdc.nctc.edu where one can register for these webinars, get contact information, and even schedule an appointment with an advisor. Other than that, you can get resources for small business owners. At this moment, I'd like to thank our funding organizations, the Small Business Administration, the State of Texas, North Texas SBDC Regional Office, and the North Central Texas College. Thank you all for joining today, and we look forward to seeing you next time. This ends our webinar.